Hello, everyone. Welcome. I'm Patricia Botero Saint Jean. I'm the founder of Open for Business, and we work with aspiring entrepreneurs with the research, the vetting, the planning, and the launch of the most ideal business for them so that they can get to profit faster and live a life with more freedom and greater income. So today we have a special guest, Dan Foss, who is going to help us understand what a business owner needs to do in order to protect the financial success that they create with the business they own. And this is something that very few business owners consider when they actually start their business. Most of us don't think about what's going to happen when and not if, when we exit our business, whether it's to sell it, to pass it on to our kids, and either retire or even start another business. So Dan is here to help us with that. Dan is a chartered financial consultant. He holds a bachelor's degree in science in finance. And for the past, Dan, almost 3 decades, right? Dan has been helping families with personal finance and estate planning. In particular, Dan helps closely held businesses and their owners with business buy-sell succession planning and key employee planning. Dan Foss has served as a past Rotary Club president and worked on various goodwill projects, such as helping to get an ambulance donated and even delivered down to Mexico to serve 3 communities that didn't have that service. He's worked with high school students to assist with community services, and he's coached youth sports. And Dan is also the proud father of a 21-year-old daughter and an 18-year-old son, and currently lives in Willow Glen, San Jose, California. So Dan, welcome, and thank you so much for spending time with us and sharing your wisdom to help entrepreneurs protect the assets that they have worked so hard to build with their business and businesses. So then,
for inviting me on to your podcast, Patricia. I really appreciate it. I'm not sure what questions you have in line for me, but I'm really more educational based when I work with people. And in doing that, that helps them through math and logic just to lead them down a path that might be most appropriate for them for planning. But yeah, I've been doing this about 26 years now, and I've enjoyed a lot of what I do. People are passionate about their businesses, and a lot of times that is their golden goose. It's their chariot that they're riding that's going to create wealth and independence for them and a lifestyle that them and their families are trying to achieve.
Great point. So then, yes, we do know that starting and growing a business takes a lot of dedication and a lot of passion and planning. And yet, most business owners do not consider what will happen to their business assets when, and again, not if, they are ready to move on. So please share with us, what are the 2-3 steps that a business owner should do to strategically plan in advance their eventual exit from their business?
Well, that changes depending on where you are in the life cycle of your business. If you're in a startup mode, that will dictate a little bit versus a growth mode, or if you're in a mature phase or maturity phase. And as you go through these cycles, you'll find that there's more enhanced or there's additional planning that's required. Whether you bring on a partner or as you go from a startup to a growth phase, you might identify 1 or 2 key employees that you want to incentivize or retain or keep on board. What a lot of people are trying to do when they start a business again is run that, and that becomes all consuming. So one disadvantage to a business owner, and they need to do it, is they're so focused on that business. Just like when you have a new child, it sends you home with that baby and you're like, oh my gosh, this is a big responsibility. The same thing happens when you start a business. You'll wake up in the middle of the night thinking about the projects you have in front of you the next day, the next week, how to attain clients, please everybody you're working with, and be successful. Most of the people that start out in a business, again, somehow forget to concentrate on their personal planning, just the foundational planning. I've done a lot of work with startup executives and tech companies. And one of the things we talk about is just get your foundational planning in place. Make sure you've got your simple wills and trusts, even though it's not business related, and planning to protect your family, and then jump on the back of that company and just ride it as best you can. And if you're fortunate enough, you're doing something you're passionate about and something that drives you as well, they'll give you extra energy. Some people do their business and become good at it and don't think about the eventuality of leaving. And it comes by force or by choice. Most of the time it's by choice. That's the ideal situation. Hey, this has been a great run. I'm ready to retire. But on occasion, some things force people out of a business, whether it's health, death, disability, bankruptcy, divorce. Some things happen that trigger the need for changes in a business plan. And that's really why I
Right.
help people to address that and be aware of that. So it's about just
Right.
figuring out where these potential potholes are, these speed bumps as you're coming down the path. Because a lot of times as a business owner, you're really hyper focused on the day-to-day operations and making sure the customers and the employees and everybody are doing what they need to do and you're getting what they can
Right.
from.
So you and I talked about a couple of things. Like, for example, we talked about business valuation. We talked about reviewing the operating agreements. So what order does everything comes into? Also considering what to do when you change ownership of the business. What is the first step to consider when you have a business? And again, most people here are starting a business and or thinking of starting a business. So at what point in the growth of the business do they need to consider these elements of planning for their exit?
Well, when you start out a business, there's a gestational cycle, a startup cycle that you have to go through no matter who you are and what business you are. And it takes a good year and a half or so just to get enough ground underneath you, get your feet wet enough, get enough experience where you go through a 12-month cycle and you're halfway through the next fiscal cycle, you can start to see the writing on the wall. Is this working?
Mm-hmm.
Do I need to adjust things? And then you can start to determine how much revenue the business is creating for you that will generate income for you. Because revenue is different than a lot of people think of as revenue coming in a business, that's their income, but there's a lot of expenses and offsets to that. So once you hit that about a year and a half marker, then that really allows you to start thinking about how to utilize the business for your own benefit, whether it's feathering your nest for retirement, with the ultimate idea of exiting and leaving, even though you're only a year and a half into it, it might be decades ahead of you. But by
Mm-hmm.
planning for this eventual exiting of a business or succession of a business, puts the business owner in a tremendous advantage versus coming to the back end of their career or whatever their business is and determining, how do I get out? It happens
Mm-hmm.
more frequently than you can imagine. I'm not a big statistics person, but about 70% of small businesses in America fail to get to the second generation. That's a significant
Mm-hmm.
amount. I think it should be more like 30%. 70% should
Mm-hmm.
make it, and 30% should maybe not make it. The reason they
Right.
don't make it is because there's no thought process to transition the business. And then what you
Mm-hmm.
have, evaluation is important, but what's really key is having a core management team. You can't have everything between your ears as a small business owner and
Right.
delegate through mental notes. Once you have a team of qualified people, and a lot of times, depending on what you're doing, that might be finance controller type person, it might be a GM or a manager type person, and sometimes there's manufacturing, distribution, or business development. But when you have that core team of people in place around you, your business becomes a more sellable asset. It's more attractive to a third party. So a lot of business owners fail to realize the end goal is not necessarily you, it's the buyer. You want to think
Mm-hmm.
about what
Oh,
the buyer would want to have, not what you
right.
need. And then understanding that type of an approach, then you're coming to the table and saying to them, we have a core management team. And as you mentioned, valuation planning. That is often overlooked by business owners. For example, I have a couple that I work with. They have a business that generates about 800,000 of salary and profit per year, and they value their business at $1 million. I was reaching over for my checkbook to tell them I'm ready to buy your business today.
Right. I'm sure.
But
I'm sure. So how much would that be? How much would that business be worth, in your opinion? And
without doing valuation planning, and if you have an entity that's generating something like 800,000 a year, the government will help you to value it. And that's probably the last group of people you want helping you or assisting you. Not that they're assisting you, they're telling you that they have a taxable event that occurred. But
right.
what they do is they determine based on what size of a bucket of money would you need to generate 800,000 a year. And they use what's called a
Mm-hmm.
capitalization rate. That's an interest rate. So the
Mm-hmm.
lower the interest rate, the higher the bucket. So they'll use an interest rate like say 4%. So if you correlate that to 800,000 a year, that'd be a $20 million enterprise.
And they tax you on that.
That couple about fell out of their seat. I did explain to them they're probably closer to 8 or 10 or 12 million, but they'll have a heck of a time convincing the government they're not worth $1 million, and they're not worth of 20 million either. So by
Right.
not having valuation planning, you leave yourself subject to the whim of the IRS or the government.
I see. I
It's
see.
easier if you
Yeah.
have a franchise because they have systems in place to say, okay, it's 1.5 times revenue. Something happens, the franchisor will buy back the franchise. You can sell it to your kid if you want to internally and transfer that business and continue it to go. But if you don't have the benefit of a franchise operation, you need to think through these logistic
Hmm.
problems and solutions on your own
Right.
as a business owner.
Right.
One of the things that's important for a business owner to do, because they do not have a board of directors like a public company, is you need to get a board of directors around you. You need to hire the right counsel, legal counsel, tax counsel, and believe it or not, someone like myself on the financial and business planning side. We all have a slightly different focus for our clients, but the ultimate goal is for our clients to win. And so what
Right.
we're talking about is legal, tax, and financial advice. If you surround yourself with those advisors, you'll find that trifecta will keep you accountable if you're missing things like not doing business valuation or
Right. Right.
or not understanding the impact your business has on your personal planning and how important it is as an asset or an income stream for you
Right.
personally.
So you really need to treat that business, as if you were, build it as you were going to sell it, whether you're planning on selling it or passing on to the kids, right? You need to build it in that fashion. You need to surround yourself with a board of directors, advisors to help you, make sure that, the exit planning is taken care of. You have a good strategy to exit your business, whether you exit the business on purpose or whether it's accidental. So what happens if somebody passes away, God forbid, but it does happen and there is no plan? What could happen?
The things you take into account is if there's any partnership arrangement or if it's a sole proprietor or single owner. They have to take into account any business debt that may need to be taken care of. A lot of times, small business owners will secure credit lines through personal credit, even though it's business related. Therefore,
Hmm.
they're commingling or muddying the waters to some degree because now their
Hmm.
estate's liable for the business loan.
Right.
So you have to make sure that you're covering liabilities and you're covering any potential future partners you may have, so you can exit or transfer the ownership to them.
I see. I see.
When you do business planning and buy sell planning, the mindset is to protect the business first, then to protect the owners. They're basically one and the same. But by having this mindset of protecting the business and owner, it flows through to the employees, to the customers, to the
Hmm.
vendors, to the suppliers. And
Right.
not that people want to have a bench with their name on it, or have some kind of marker for their great work they've done in their entire lifetime. But if you have a small business with 6 employees and you benefit 20 or 30 customers, and there's a whole chain there of people that are benefiting from the services that you're providing.
Hmm.
So by having a continuation plan in place, it just ensures that all those groups are also taken care of, not just
Right.
owners and the business itself. But
Right.
it's really about protecting the ownership and protecting the business so that third parties cannot buy in. For instance, if
Right.
somebody goes bankrupt and they're a partner, there's language around that, how to deal with that, so that doesn't dissolve the company. Uh,
Okay. And divorce, for example, there's also language. So that's part of the operating agreement. Is that correct?
yes, and a lot of times the people will find out, their spouses actually will find out that they're being requested to sign a document that agrees with the operating agreement. And so
Okay.
another way of stating it is the operating agreement makes sure that you don't end up in business with your partner's spouse and their attorney.
I see.
And the
Yes.
spouse and the attorney know little or nothing about the business, but they know it makes money for them and they want the money. And
Right.
so what
Right.
you're doing by protecting yourselves with appropriate buy-sell planning is making sure those types of things don't happen. Then you're taking care of that partner's spouse as well in that
Right.
mindset. But they don't have control of the business in any way if something happens to their spouse as a partner or an owner.
Okay. Great. Okay. Wow, that's a lot of information. And just wondering, is there anything else, besides all this planning that you gave us, offered to us to as a foresight for the potential exit of your business? Do you have any concluding word of advice for entrepreneurs and aspiring business owners from your perspective as a financial advisor? What is the biggest danger to avoid when starting a business?
Well, a lot of people focus on the business and the business planning, on income and expense reports, and they're flowing through all the financials of the business, and they don't do any personal planning. So they're 100% focused on what the business will do, but they don't integrate how the business relates to their personal planning. It's important to understand because most small business owners get about 50% of their income for their house and their lifestyle or more coming from their business.
Mm-hmm.
So understanding how much revenue is being generated from your business to support you personally, you need to build a model to determine how much do you need at the back end when you do leave the business, because you're going to be handing that business off to somebody else, and they're going to be receiving that income and that profit distribution. So how important is the business as entity, as an asset in your personal financial planning? So
Right.
building and mixing those two thoughts together. How does the personal and the business planning interrelate with each other for my own benefit, for my own retirement and my own estate planning? And that's a lot of times it's overlooked. People think of them as mutually exclusive when they're not.
Yes. And it requires a different mindset, correct? I mean, when you're a business owner, you are aggressively trying to grow that business. You're pursuing, goals and increasing the value and increasing the sales and etc. But the business planning, as you mentioned before, requires a different type of mindset. It's more of a defense. Is that what you were mentioning earlier?
But some people say, how much do you want to get from your business? And a lot of people can't answer that. They don't know. They know a number. If you said it, they would sell the business. There's definitely a number that will make you walk away. But when you ask people, how much do you need from your business when you sell it? A lot of people just shrug their shoulder and say, I'm not sure.
I know that.
It makes $500,000 a year for me, and I know it does that.
That's one of the elements. Yeah, that's one of the elements I teach to my clients is, how much equity do you want to get out of this business, in 5 years, 10 years, or 20 years when you're ready to leave it. And part of what you do is also having that mindset, right, of being proactive of what you want the business to do for you in your life, which is, the whole reason we become business owners, right?
Yeah, it's for you, your family, and your lifestyle.
Yes, absolutely. Yes.
Some people are more philanthropic and they do it for the better of mankind, but 80 or 90% of them or more are doing it for themselves and their family.
And you can do both, right? You can have a business that serves a purpose and also that serves you. And that's the beauty about
the best type of business.
Yes, that's the beauty of business ownership. Absolutely. Well, thank you so much, Dan, for your time and for these valuable words of wisdom. And for anyone who wants to reach out to you and discuss the buy, sell, and the planning of their business or the planning of the exit of that business, what is the best way to contact you?
First, thank you again for inviting me on. I'd like to be a resource to any individuals that may be searching for any type of advice or help along the lines for business buy, sell, and key person planning and how that dovetails into personal estate planning. You can reach me at Foss Financial Services. Again, my name is Dan Foss, and I've been doing this about 26 years. You'll find on that website as contact information where you can get a hold of me, and even a comment if you're something that's on your mind that you want to discuss or get information about. Again, the way that I've been trained and educated is just to provide education to people, and through that will lead you on a path that suits you as far as process of eliminating, what choices you have. There's more than one way to build a business. There's more than one way to exit a business. But by going through all that with people, you can help them to determine their best path or best choices.
So it's fossfinancialservices.com, correct? Yep. That's your website. Perfect. Okay, great. Thank you so much. Take care.
All the best.